Hey everyone, how's it going? Dan Russo, Chief Market Strategist here at Chaikin Analytics. Hope everybody's having a good Wednesday and the week is going well so far. A little bit of a dreary day here on Long Island, but we're inside. We're watching the market, so I wanted to come to you with some updated thoughts here. With the major averages all down around 3%. As I look over, the Dow down 2.9%, the NASDAQ down 3%, the S&P 500 down 2.9%. As I record this, 12:45 on Wednesday afternoon. Wanted to hit you with some thoughts. First and foremost, 3% moves to the downside, not something you want to see if you are bullish on the equity market, which we have been. But let's put it in perspective. Let's zoom out. All right, this is where time frames matter. This is where it's important to kind of understand who you are as an investor or a trader. In short term, the trend is down. It's under pressure. In the intermediate and longer term, the trend is consolidating within the context of an uptrend, right? So intermediate term consolidation, that's been in place really since those highs in September. But that consolidation is playing out within the context of an uptrend, okay? So what does that mean? That means we utilize some other indicators to figure out where we are within those phases of the trend. Our overbought, oversold indicator, we've been writing about it in our notes to Chaikin clients, and you can take a trial. Head over to chaikinanalytics.com to sign up for a 14-day trial. We've been writing about the fact that the SPY, the Qs, and the IWM are all oversold within the context of these consolidations in the uptrend. So we're actually using that as an opportunity, in our opinion, to look for ideas, bullish ideas, especially in areas of the market that are leading. Now remember, sometimes doesn't necessarily have to be the United States. In my note today, I highlight the fact that emerging Asia Pacific is market leadership at the equity level. ETF that tracks that market, GMF, trading near 52-week highs, and it's been outperforming the S&P 500 for some time. It's actually been a better place to be if you're an equity investor than here in the US investing in the S&P 500. So we drilled down on holdings and what's in there. A lot of Chinese companies that are holding up well. Names like Alibaba and JD, right? So there are always opportunities out there. The key is to kind of utilize the roadmap, figure out where you are on the terrain, and then figure out who's leading, who's lagging, where do you want to see the opportunities. So with that being said, we want to turn to risk management. Our bullish view on the market, as I've written, is negated when SPY breaks 320, okay? If QQQ was to break 260, 250, I'd have to rethink my views. And if IWM broke the 145, 140 level, we'd have to say that these consolidations have now resolved to the downside. And if they resolve to the downside, we're going to want our risk management process to kick in. We're going to want to become more patient, give the market time to set up. Does it guarantee it's morphing into some sort of collapse similar to what we saw in the beginning of this year? No, but below those support levels, the odds of that are increased. And we don't want to be on the wrong side of those odds, especially if they continue to move in that direction. On top of that, you do have some headline risk, right? It's a busy week for earnings, number one. We've heard from names like SAP. I chimed on that. Microsoft actually kind of debunked everything that SAP had to say. Microsoft's print was good. Stock trading lower because it failed to meet lofty expectations. We're still going to hear from Apple. We're still going to hear from Amazon. We're still going to hear from Google and Facebook this week. So some monster names still set to report, all playing out while a high-profile hedge fund manager, David Einhorn, called tech a bubble and said he was now going in and selectively shorting names within the tech space. Number one, that's his job, okay? The headline is that Einhorn is calling tech a bubble. But if you read the articles, he goes on to say that he is looking at second-tier companies and recent IPOs trading at lofty valuations for the short side of his book. Well, I hate to say it, but that's his job, right? So him saying he's shorting what he thinks are second-tier companies, i.e. lower quality companies, is not the same as tech is a bubble, short tech. So let's just get that clear. I think if you've come across that headline, it makes sense to read the article and drill down a little bit further. If he's running a long-short hedge fund, his job is to be long some stocks while short others. Ideally, he's long the stocks that he thinks are high quality, fundamentally, with good management teams and positive catalysts, and he's short the names that he thinks are lower quality, maybe lesser management teams, with catalysts that could potentially move the stock to the downside. So the headline is that tech is a bubble, but if you read the article just points out that a hedge fund manager is doing his job. At least that's how I see it. Those are my thoughts on a Wednesday afternoon. Hope everybody's having a great week. We'll be back to you again soon with some updated thoughts. Be well, be safe, and if you're on Long Island, stay dry. We'll talk to you soon.